Hello and welcome to the channel. Today we're talking life insurance. And one of the most common questions out there in reference to life insurance is, what's the difference between term life insurance and whole life insurance? And the challenge is there's a lot of one-sided information out there for both sides. And when you read about something or hear somebody talk about it, it seems like they're only giving you the good and not telling you the bad side of it. And we already know there's no such thing as perfect insurance. So I'm going to give you both sides, both the good and the bad. So my goal today is to give you both the pros and cons of both so that you can make the best decision for you and your family. First, we're going to go over term life insurance. Term insurance is pretty straightforward. You get approved for a certain amount of death benefit coverage, and then you just pay the premium. And the premium is just the insurance company's terminology for payment. So anytime you hear the word premium, just automatically associate that with, okay, they're talking about the payment. And that premium payment can be done monthly, quarterly, semi-annually, or even annually. Typically, you'll save the most money the more you pay your premium in advance. For example, I looked at a few policies, and paying your premium annually actually saved you 5% versus if you were to pay it monthly. And the three factors that determine how much you pay for insurance are your age, your health, and your gender. So obviously, the older you are, the more expensive the insurance gets. Also, the less healthy you are, it also affects the policy and makes it more expensive. And it's cheaper for women than it is for men. Now, term insurance is typically offered in increments of 10 years, 20 years, or 30 years. All that means is when that block of time is up, then your insurance is over. So if you have a 20-year policy, you count out 20 years. When it reaches year 20, your policy is over. Now, one of the best things about term life insurance is that typically it's one of the cheapest insurance policies on the market. So it does a great job of fitting inside of a family's budget. Now, when it comes to how much life insurance somebody should have on themselves, typically you want to aim for at least 10 times your income. So if you're making $50,000 a year, you want to at least have $500,000 of coverage on yourself. And term life insurance will give you the most inexpensive way of accomplishing that goal. So as a byproduct, you'll also have more money freed up to do other things like, invest, or if you want to add money towards your mortgage or anything else you want to do, because it's going to be less money out of your pocket. For example, a quote for a 30-year term policy with $100,000 in death benefit coverage for a 30-year-old male who's healthy came out to be about $17 a month. So that can give you an idea of how affordable these policies can actually be. Now, on the flip side, the biggest disadvantage when it comes to term life insurance is that it's only temporary. Like I mentioned before, once that period is over, whether it be 10 years, 20 years, or 30 years, your policy is done. And when I say done, that means you have no more life insurance. And statistically, most people outlive their term life insurance policies, which technically is a good thing because that means you're still alive. But it's important to know that most of these policies never end up paying out. Now, if you were to die during that time frame, the death benefit would definitely pay out to your beneficiary. Now, the sales pitch that you'll hear when it comes to term life insurance is that, oh, you get this 20-year policy, and in 20 years, you'll be wealthy and you'll be technically self-insured with your own wealth, so you won't even need insurance anyways. But in the same breath, they'll tell you that the policies are renewable, so at the end of the 20 years, you can always renew and extend your policy, which is a huge contradiction, and it leads me to wonder if you even believe yourself when you tell me that I'm going to be wealthy in 20 years and I'll be self-insured because I'll have all this money. But unfortunately, statistically, the average person does not end up wealthy at the end of their 20-year policy or their 30-year policy. That's just something I want you to be aware of when you do speak to insurance agents. So more than likely, at the end of that period, whether it be 20 years, you will have to renew your policy. Now, the challenges with that are, one, now you're 20 or 30 years older, which has a huge impact of how much you pay monthly towards that policy. And two, maybe you had a change in your health condition, or maybe you gained some weight over that 20 or 30-year period, which has a huge impact on the cost of your insurance. In some situations, you could have been flagged with some type of health condition or a diagnosis which deems you as being uninsurable, which is extremely unfortunate because now you couldn't even get term life insurance even if you wanted to. So those are a few things to take into consideration when looking at getting term life insurance. Now, when it comes to whole life, it's not as simple, mainly because there are a lot more variables that actually go into a whole life policy. The first thing you have to understand is that when it comes to whole life, there are typically two different types of life insurance companies that offer them. There are stock companies and there are mutual companies. Non-participating whole life policies are offered by stock insurance companies, And participating whole life policies are offered by mutual life insurance companies. Now, the difference between a stock company and a mutual company all comes down to what that company does with their earnings. Stock insurance companies can distribute a surplus of their profits directly to shareholders in the form of dividends. And mutual insurance companies can distribute a surplus of their profits directly to the policyholders in the form of dividends. So that's what makes whole life insurance from a mutual company a lot more attractive, mainly because you have the opportunity to earn dividends into your policy. But before we go into dividends and how that actually work in relation to your policy, I did want to go over the biggest disadvantage when it comes to whole life. And that's the fact that it's the most expensive life insurance policy that's on the market. For comparison purposes, that previous policy I mentioned, which was a 30-year term for a 30-year-old male for $100,000 of coverage, came out to be about $17 a month. Now that same $100,000 coverage in a whole life policy came out to being about $69 a month, which is a difference of $52 extra a month. So you can see right away why somebody would choose a term policy. When you look at the coverage amount, dollar for dollar is just dramatically cheaper. Now here's why whole life policy is more expensive. Because nobody really talks about why whole life is so much more expensive than term. I mean, it's the same amount of coverage, isn't it? So here's what you're actually paying for if you choose to get a whole life. Whole life policies are considered to be what's called permanent policies. That means as long as you pay your premium, there is a death benefit that is guaranteed to pay out to your family. And with term insurance, the life insurance companies already know ahead of time that there's a 99% chance that you will outlive that policy, which means they will never have to pay anybody anything, which makes term insurance extremely profitable for a life insurance company. But when it comes to whole life, the insurance companies know there is zero chance that you're going to outlive that policy, which means they will definitely have to pay out a death claim one day. So of course they're going to have to charge more in the meantime. We can't forget that the number one rule of all companies is to make a profit. They just make their profit in different ways depending on which policy we're talking about. Now your payment with whole life policies is also fixed and is guaranteed to never increase. So when that same 30-year-old turns 95 years old, they still are only required to pay that $69 a month for $100,000 of coverage, which is beyond amazing because most insurance companies don't take on any new clients after they reach the age of 80. So with whole life, you're actually locking in your life insurance policy for the rest of your life. The way the payment is calculated is all they do is determine how much the cost of insurance will be over your lifetime, and they just give you an average. That's why it stays the same consistently for a 30-year-old all the way to a 95, 100, 105-year-old. So the fact that you're paying an average is the reason why your payments will never increase even as you get older. So other than the fact that the death benefit never expires, another thing that attracts people to whole life is the fact that they can have cash value. So here's how that works. When you make your premium payments, there's a portion of that payment that goes to an internal savings account called cash value. So your payment goes into the policy, the insurance company deducts all the cost of the policy, and whatever's left over is what lands inside that cash value. So one amazing feature with cash value is that you're able to overfund your policy to increase your cash value. All that means is that you're paying a higher premium than the policy requires so that that additional money can land inside your cash value. But at the same time, it's extremely important to have an experienced agent that knows what they're doing because you don't want them to have to increase your base death benefit just because you want to add more money to your cash value. Because doing so will give you unnecessary cost, which defeats the purpose of adding more money to your policy. So if you are looking to max fund your policy, you definitely want to look at an illustration first so you can get an idea of what your cash value should look like over the next year, 5 years, 10 years out. And when the policy is structured correctly, you should see cash value in the first year. You don't have to wait 5 years or 10 years to build up any cash value. It shouldn't work that way. But unfortunately, I do see a lot of policies that are set up that way. Just make sure that doesn't happen to you. Also, in participating policies, you'll usually receive a fixed 4% compound interest rate that goes towards your cash value. And an additional 1% on top of that 4% gets added to your policy in the form of dividends like I discussed before. So when the company makes a profit, they take some of that surplus and actually pay it towards the policy owner's policies. Another feature with whole life is that you're able to take out policy loans. And it's important to know that when you do take a policy loan, you will be charged interest on that loan from the insurance company. And most participating policies charge about a 4 to 5% interest rate on that loan. But a great feature with these policies is that even though you've taken a loan against the policy, you still earn that compound interest of that 4% and that 1% dividend as if the money was never touched. And just so you understand, you could withdraw money from your insurance policy. I know there's a big misconception that makes it seem like you can't, but when you do withdraw from an insurance policy, you do have to pay tax on the gains. So people use policy loans because, for one, it's tax-free, and for two, they still earn compound interest on the entire amount as if it was untouched. So as you pay back your loan over time, you can actually make more money on the interest you're earning on your cash value than the interest you're actually paying on your loan. There's not many places that you can do that. And that's why the loan provision is usually the most attractive area for people when it comes to these policies. So when it comes down to it, some people feel they only need a temporary death benefit for a specific amount of time, maybe to cover a mortgage, or maybe just to cover their income until their children become independent. And on the other side, some people want their death benefit to be permanent because they want to guarantee they leave some financial assistance for their family when they pass away. Or maybe they just like the idea of the cash value. And in some situations, people want both policies. But ultimately, it's all about what you feel will help you accomplish your goals. So there's the breakdown on the differences between term life and whole life. I hope this helped. Don't forget to subscribe for more financial content, and I will see you in this next video.